Welcome back to Good Returns. I'm Matt here with Garrett. Back to our regular weekly format after the lack of caffeine's hitting after last week's quarterly review. And this week we do have a lot to get into. Divided Federal Reserve, a jobs report that looks worse than it is. Very interesting information there. And a planning room topic that I think a lot of parents have been waiting for, or at least have heard about. Hopefully we can provide some guidance. I'm looking to learn from this segment as well.
Yeah, we've made a couple of social media posts about the Trump accounts, but they launched last week on July 4th. We've been fielding questions about them, who they are, what they are, who they qualify, who qualifies for it, if you should open one. We're going to walk through all of it in the planning section. So stick around for that. We're going to get into the details.
Yeah, we'll get into that. It's very interesting. Anytime legislation, regulation changes that may open up a way to invest, a way to have better tax treatment, we want to pay attention to it. But before we get into that, we'll talk about the Fed, the jobs report that's worth understanding with a clear mind. And a quick note before we get into it, everything on Good Returns is for educational purposes only. Nothing we say should be construed as personalized financial advice. We're here to give you context, help you think more clearly, and always keep in mind, work with a trusted advisor. And if you don't have one, go to momentumwealth.us. We help clients all across the country make better financial decisions. Let's get into it. Yeah, we were looking at if we look at the main indexes, the S&P up a little bit for the week, 0.7. NASDAQ was, again, the most volatile. This time the volatility was to the upside at 1.5. Russell 2000 took a break, basically flat. So modest gains at the index level, but the picture underneath that was a little more different when you kind of peel back the headlines.
Yeah, I think, and we're open today, the market's open. So some of these will kind of change. The market's down, it looks like, or kind of flat in some areas. Russell 3000 actually up, which is very interesting.
The Russell 3000 is generally considered the total market.
Right.
Not everything, but the total
That's
US
what we like to
market.
refer to as the market. We've talked about it before,
market,
but we
yes.
look at the Russell 3000 essentially for, a lot of the things we do here. Certainly momentum strategies that we use that quite heavily. But
the total market, Bitcoin up today.
Yep.
Total market is up today, although you have, I don't know, you'd say I really call it flat across the other indexes.
It is. I mean, the NASDAQ is maybe outside the realm of flat, but only by a little bit. I mean, it's not, we've got, let's see. If we look at it in real time, it does look like we've got some of the chip companies and things kind of taking it on the chin this morning. We've got Intel down 3%, Marvell down 3%, Dell down, your usual suspects. But yeah, I mean, if we look at the sectors this week, 8 of 11 sectors declined, only having energy and technology posting gains there. Growth and momentum strategies tend to outperform this week, while value and equal weight S&P lagged. That's the narrow rally dynamic returning, and we've talked about the broadening of that market. A handful of names pulling the headline index higher, while most of the market moves the other way. So we saw a lot of broadening throughout the last quarter, but this week is sort of a reminder that it's not always a straight line. There are some things that come in and happen that change that.
On oil, renewed tensions surfaced. Oil did move higher, but has retraced.
Yeah.
So
we're still in the 70s.
Only up, I think we're at 71, call it 71. So up about 4% in total. So we had a peak and then we had a pullback. Seems to be the same story every time. Oil catches a bid on either a headline disruption or actual realized disruption, it just gets sold right off. So it's the market's clearly has recalibrated how it's pricing geopolitical risk in energy.
Well, this particular geopolitical risk.
Yeah. Very, 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 very interesting. Still, we have the global energy analyst still saying we're at a minimum 1 million barrels a day oversupplied, which is just shocking considering everything that's going on with that. But yeah, so that's kind of muted, I would say.
Yeah. We're not going to spend a lot of time on it. I feel like it's a recurring theme, but we'll keep watching it. It's, it is what it is, but I think you're right. The muted response there kind of signifies the market believes that disruption is largely contained and more temporary than what we might have gone through earlier in the year where, there was a higher level of uncertainty. Not to say there's not uncertainty still out there, but I think it's just more moderated at this point. That's what it appears to be.
Yeah,
at least.
and I think the undercurrents that are happening in the economy, it's just not a really good structural setup for runaway commodity prices, whether it be oil, whether it be copper or aluminum. The thing is when you have demand uptick in commodities, people are going to find a way to get that to you. You'll see that with rare earth minerals. You'll see that with aluminum and copper. So just very
gold taking it on the chin today too.
Very interesting. Yeah. So you've had gold struggle to get past that resistance at the 4150, 4160 level, if I'm not mistaken, close to that. Bonds fell. Treasury yields rose, maybe driven by the oil move in the June's minutes of the Fed meeting. So let's get into the Fed minutes. So the Fed released minutes from its June meeting. The minutes are where, so they'll talk, and then you wait with bated breath for the conference. Well, they meet, then you wait with bated breath for the talking, and then you wait another 30 days for the minutes of what they talked about in the meeting before they came out and spoke.
Yeah.
So let's talk about that. Let's talk about the talking.
Well, all of this is sort of the prior regime, and I'm not just talking about Powell, even before that, but now we're moving into a new Federal Reserve with Warsh as the head, and so is that going to continue to happen? It's his first conference. I mean, his first press conference.
We already know the communication is going to go down as it should, because when you look at the minutes, the officials that made the case, knowing that their words would be written down and then shared with the public, pointed to, that made the case for potentially raising rates, cited near-term noisy data, things such as the Middle East conflict, tariffs, AI spending, that really play out over a very long period of time, and kind of giving an opinion on maybe in the short term we should do this. The exact same thing happened with the people that wanted to lower rates, is they were pointing to just very, very recent job market data to kind of build their case for, again, the job market there's some changes occurring that's really very structural, very long-term, very, very secular in nature, but they're making the case based on short-term movements. So I really don't pay attention to any of this now, because we know that the entire apparatus of the Federal Reserve is being flipped on its head to change how they're interpreting data and which data sets to place the most weight on to try to get more of a longer-term handle on things. And I don't think that's a bad thing. So I kind of take both sides of this with a grain of salt, simply because the information that the framework they're using to come to these decisions is changing. So it doesn't really matter what they said last month, because over the next couple, 3, 4, 5 months, that the whole way that they look at it and the data that's presented to them is going to be changed. So it doesn't really matter.
Yeah.
Yeah, that's the way I think of it. But
well, I mean, that kind of highlights the point of, I got to think that there's just going to be kind of nothing that happens for the rest of the year as far as the rates are concerned, unless we get some kind of huge catalyst for it.
Well, that makes sense too, because if you take them at their word, and the 5 main areas that the task forces,
which we're starting to see
the
announced,
task force I,
yeah,
have been created. Those 5 areas are the entire way the Federal Reserve operates. Basically, it touches every important area of the Federal Reserve. So if they're saying we're going to upend all of this, then I wouldn't expect major changes until they do that and then operate off that data.
And there has always been a group of people that are outside the Federal Reserve that tend to give some insight into the Federal Reserve about kind of policy and things they're thinking about. They always go outside of themselves and kind of get other, information. They get information from other people. They get suggestions. They get,
they're academic. They're very academic.
But you just thus far really haven't known who they were. So these task force are kind of naming them. You saw Mark Andreessen named to one yesterday. There's a handful of other people that are named. And they're not just, this is a Trump appointee, but he's appointing, Obama era appointees to these task force. So that's going to be
very academic approach. And I don't think it's a negative. I think it's a positive. And I'm always in favor of more transparency. So if a lot of these Wall Street guys or a lot of these pure academics from the universities are already in the background, kind of giving opinions, well, let's bring them forward to like true transparent public policy debates, and let's see the best ideas. So, I think it's a good thing. The AI spending was probably the most interesting note from the minutes. I think everything else just dismissed, but the AI spending.
It's the first time they've mentioned that. First time they've explicitly named AI spending as a potential inflation risk. So they're saying a lot of money is flowing into these data centers, billions of dollars into chips and the data centers and the infrastructure. They create demand for energy and labor and materials, and they could put upward pressure on price. Again, but that's like a speculative thing.
This is what irritates me though about that is still stemming from a very antiquated way of thinking that does not have the public's interest at heart. And I'll explain why.
Well, it's still the same governors, the same board is there. The only thing that changed was the leader, the Federal Reserve Chairman.
That's true. That's very true. But this is what irritates me about, the inflation. The inflation comes from one place, and it's the government. Period. Full stop. Milton Friedman laid out the case for this eloquently in the 70s and 80s, and it is a universal reality. It is a law. It's a gravitational law. So when you say that companies that are expanding and they're willing to take capital and deploy it, they're willing to risk capital by hiring people, by purchasing product, that the demand for that labor and product is a bad thing because it could make prices go up. That can make prices go up for those that are supplying the labor, meaning people get paid more. That's a good thing. That maybe could make prices go up for chips, which we've been wanting to onshore to get rid of the Taiwan-China geopolitical risk issue, because all of the chips are made in Taiwan. And if there is a conflict there, the entire economy comes to a complete 100% worse than COVID level stop.
Yeah, yes. No, refrigerators are not the only thing you can't get.
Yeah, it's a big deal. And so if demand for chips makes factories be built to supply those chips, there's more jobs, people's wages go up. So when I hear talk like that, it irks me a little bit, because it's saying that businesses expanding and people getting more jobs, and construction workers and those with the expertise in those fields and setting up those data centers, being able to demand higher wages, then that's a bad thing. We're going to have to punish the economy with higher interest rates, because people in North Louisiana, in North Carolina, in Central Georgia, where these data centers a lot are being built, like they can't get higher wages because we interpret that as inflationary. Because they do look at that. They have historically said if your wages go up, that's inflationary. Like, everybody wants to make more money. That's a good thing, right? Yep. So I understand there are nuances there, and I understand somebody could come along and try to debate that point. But
I think this also goes to Warsh's point. I would be interested to see the background that Warsh had into the Federal Reserve Board and the meetings before he actually became the chairman, because the things that he said, particularly in his first sort of speech, his first announcement or press event or whatever you call it, he hit on all of these points preemptively. And maybe it was because they had already had the meeting and he knew what was going to come out in the minutes, but he talked specifically about the idea that the dual mandate, and you can kind of order the mandates and say which one, should matter more and which one should matter less. And maybe he did that because he heard the conversations going on in the room about, I'm concerned about labor, I'm concerned about price inflation, I'm concerned about wage inflation. And he just preemptively was like, well, this is all going to change. So
yeah, and you have to say, okay, well, you may have, let's say there's the demand for, because we know several people in Louisiana, the Monroe area, that either them directly or their family members are benefiting a lot from that giant meta build out that's over there. I talked to one client who's, I believe it was their grandson and his new wife are able to, for the first time, buy a house because of the job that he was able to obtain at Meta. And so, yeah, okay, labor may go up a little bit because people are able to, demand a higher rate for their labor. We saw this during COVID, right? When labor shortages and people, and it's still, Panda Express is like still $20 an hour, right? I mean, that's good. People can go and incentivized and.
That may be an outlier though.
I mean, I don't know. Buc-ee's is like,
that's an outlier too.
150 grand.
You're all out. Those are all outliers. Although minimum wage is higher, but
I don't even think people. I could be wrong. I think most of the time the starting is always above now. We've hit a point where.
Yeah, I don't know I don't know. I don't know that I would go that far to say that because I'm sure there's jobs out there that start at the minimum wage, but I've
just seen a lot that are higher, and that's a good. I believe that is a good thing. But aside from my disagreement that we should have finger wagging when people are able to make more money because of their labor, they're demanding more prices for their labor. Ultimately, we know, and we have 120 years of data that shows when you have technological innovation, you always have deflation. There is not one instance where that has not happened. And so even if you get some push-pull dynamics that the Federal Reserve may find uncomfortable or some members of the Federal Reserve Board may find uncomfortable, the AI spending is going to be structurally deflationary because it has always been that way. When you have technological innovation, you have prices that come down. So the productivity gains should lower cost across the entire economy over a period of time. And, I just think that necessarily these 5 groups that have been put together to help reimagine how the Federal Reserve can better fulfill their public mandates from the people, from the Congress, I think it'll take a more longer-term view, less emphasis on short-term things. Because there's a lag anyway. You change rates, it's going to be 9 to 12 months. And then you change them 6 months from now, it's another 9 to 12 months. So you have 5 years of slow policy changes one way or the other for something that's happening very, very quickly. You have to think bigger picture and say, okay, we know
it's
the
not
trend.
Even that quickly either. The data that they're using is not that up to date by the time they're using it.
Year-old data to implement a policy that takes a year to take effect.
Yeah. So you have on either side of that. I have an answer for you. The Bureau of Labor Statistics' most recent detailed data found that only 1% of hourly paid workers earn the federal minimum wage or less.
1%. So that's a 1%. Big change. I'm sure that used to be a lot higher. So I wouldn't look at that and say, oh, that's inflationary. No, I don't think that's that's inflationary. I think that's people's wages catching up to the inflation that's already occurred.
Yeah, the trend is down. About 10 years ago, it was almost 3%.
So been cut by 2/3, relatively speaking.
Yeah.
So I think that's what we're going to see playing out. I don't believe that we're wrong. Every one of us is without excuse in living through what it means for technological advancements to lower cost, and that's really in any area. I mean, we've spoken about oil ad nauseum, but look at
I thought about getting like a little horse stuffed animal or something over here. We grab a stick and just beat the horse every time we talked about oil. Go ahead. Sorry. Just popped into my mind.
So let me. I've said this before, but it's worth bearing again. The inflation adjusted all-time high for oil in 2026 dollars was $215 a barrel in June of 2008. Because of the technological innovation of fracking and the more efficient movement of oil through pipelines and less on rail, even with all of this hoopla, you cannot break 120 a barrel. And obviously we can't break 75 a barrel now. So innovation lowers cost. There's just no way around it. It's a gravitational reality. So, if you inflation adjust today's $70 a barrel oil to $2008, you're going to see the exact same, that it's significantly cheaper. So it happens everywhere. VCRs to computers relative to compute power.
Yeah, I mean, Apple just raised the prices across the board.
Yeah, but still look at
chip-based.
Yeah, but look
kind of devices.
The power of this thing right here, and say, what, 20 years ago, how much would you have to spend to get?
Of course,
it's insane.
But I mean, when you go from where you were to, we talked about it last time, but the Apple TVs experienced like a 60-something% increase. I mean, that's a big deal on a device that was, sub $200 is now not. And so,
and how long do you think, if that's because of memory, if that's because of RAM?
Yeah,
okay,
that's the excuse. But
look at the chart of RAM.
The more interesting thing will be to look at the earnings that they report after the price changes go into play and see if the sales are still the same. I'm not sure what part of the revenue that Apple TV division is. It may be such a small part that they don't really care. But
it's just the RAM stuff, which apparently, so my oldest, who'll be starting driving within the next 9 months. Crazy.
Godspeed.
We bought him, he loves space stuff. So we got this telescope. And he can take these long exposed images and then stack those images to tune out the noise. And you see these pictures of these galaxies. It's pretty impressive. And he's gotten all into it. Problem is the space, because you have to take like hours of these high-res photos and you have to stack them, and it just eats up gigs. Mm-hmm. Just boom, 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 boom. So he was asking about a hard drive, and I was like, oh man, I don't know. I'm digging through. I actually found an unopened hard drive, which would now cost like $300-400. I paid like $60 for it or something, because the RAM prices or whatever have gone up so much, or whatever it is.
What's the size of the hard drive?
It's pretty big. I don't know what 500 gigs or a terabyte or 2 terabytes. It was a lot. I don't know what a lot is now, but it was a big one. I think it was 2 TB.
Okay.
2 terabytes. He filled it up pretty quickly, but then he was telling me last night that because of something else, because I had bought his brother one of the Mac Minis, and we could never get it to get the stuff off his phone, so we wouldn't have to reset all the time limits on everything. So he kind of lost interest in it, and so his brother sold him the Mac Mini, and then took his profit, which wasn't a profit because I paid for the Mac Mini, but then took it
100% profit,
and then came to me and invested the $400 that he made from selling the Mac Mini that I paid $600 for to his brother. Anyway, he's already eaten
some
up.
Money missing in that equation.
Yeah. I'm at a $200 loss in the transaction, but he made $400 in his mind. But he's already eaten all that up. And so he's like, man, I was looking to get another one of those hard drives. It's like, $300 or $400. And I was like, just wait, because that's going to come down, and it will significantly.
Well, it has, but I don't know. Hard drive prices, yeah. I mean, the hard drives I were looking at, this is probably super interesting for people listening to the show, but the hard drives I've been looking at recently, because of this show, we use a lot of, with all the footage and things that we're using. So we use
our sponsor,
not a sponsor,
our sponsor for the show.
Those are up there. A 5 terabyte, 6, 7, 8 terabyte hard drive is going to be $400 or $500. So I mean, it's still not. The prices could come down, but they have come down. I remember when you used to go and get a thumb drive from like Circuit City or something. It was like a gig or something, and it's like $100. So it has come down a lot, but I think there's still room for improvement. But let us get into the June jobs report. We talked about the jobs report. Came out, and the headline number
hold on a second. Now we hold on.
We have to move this along.
Just hold on. While we have seen a price for hard drive storage and solid state drives go up recently, the chart from beginning in 1998 was $53 per gigabyte.
Yeah, that's what. Yeah,
53 per gig, which has collapsed all the way down to pennies.
Yeah,
per gig. As you were,
my Circuit City example,
as you were, good sir,
is astute there. The jobs report. Employers added about 57,000 jobs like half of what economists expected. Prior months, we had some revisions down, and that kind of might look like we're having trouble in the labor market. Kind of have to read deeper than that, because your actual unemployment level fell to 4.2%. So that's down from the peak. If we remember in fourth quarter of last year, we were at 4.5%. So if you look at the first half of 2026 as a whole, hiring averaged about 92,000 jobs per month, rather. And then if you compare that to the second half of last year, the economy was actually losing about 7,000 jobs. So that's a pretty good turnaround, and it warrants kind of a deeper dive into just the headline numbers. So that idea of headline works on the market side, it works on the jobs. You get a headline number, you have to read more deeply into it to figure out the logistics and the understanding of it.
Yeah, it seems that, and others have taken the view that the government statistics have become kind of distorted a little bit. So it's kind of a weird, it's become very, that was definitely a weird report. So a lot of people have been looking more at the private sector data, with some people even bringing up the World Cup and kind of its impact on the labor market. But definitely the decrease down to 4.2 was driven by probably more people leaving the job market altogether, because you did have the labor force participation rate decrease. So you've had people get out of the labor market. That's probably, the baby boomers are still the largest generation, and they are retiring, somewhere between like 5 and 10,000, every few days or something of that nature. So it's definitely a peculiar read. But it's more, I think I interpret it more as a soft patch, stabilized, and then gradual improvement. So we'll have to see how the rest of the year plays out to see if June was an outlier or the beginning of actual softening. Obviously, one data point doesn't answer that. The context suggests that it's a peculiar read that doesn't necessarily inform a trend, but we'll have to wait and see.
Yeah, the other interesting part of that is that, going back to the Fed being divided, it will be interesting to see how they interpret that data, because you have committee members who maybe favor cuts are going to point to that number as evidence that the labor market is softening, and then people who favor hikes are going to look at the employment rate of 4.2% and say labor market's still tight enough to withstand hikes. So both sets of those people looking at the same data, drawing different conclusions. That's just an interesting kind of anecdotal point to look at. It'll be interesting to see what they say. But yeah, 1 month doesn't change it. We got to watch the next few reports to get some more detail there.
And I guess just to circle back real quick to the AI narrative on semiconductors, not on Semiconductor, which is an actual company, ON, but on the topic of semiconductors. We have a note here about what this week really illustrated, and it came off some of the commentary you were giving last week about earnings reports and why some of these names may sell off, even though the trend is still positive, maybe even accelerating, but how you're going to have volatility in these names. And this is something that you should expect to see when you have this much money being poured into an industry. You're going to have things will not necessarily go the way you think they will, and competition is absolutely at the doorstep of a lot of these big names, as the entire world competes for what is multiple trillions of dollars of CapEx spending over the next 5 years.
Yeah, the name we had this week was Samsung. If you look at Samsung, they reported record quarterly profit. They beat their estimates. Stock still sold off.
Yeah.
Why did the stock sell off? I mean, you just have an issue where record profit wasn't even enough to meet the market's expectations. Yeah. The bar has gone so high that even strong results can potentially disappoint, which we've talked about. When are we going to reach that inflection if we don't keep getting more? At what point do you not get more? And what does that do?
This is where, in these short-term instances where the trades get crowded, yes, it's great if you're in a momentum stock sleeve, if you held a couple names that for just some reason years ago that you bought, you like the company, now it's up, or if you're very concentrated into market weight indexes such as the S&P or the NASDAQ, And when the going is good, you're enjoying it. But when it gets crowded, that math changes. The questions being asked is no longer, is this company doing well? Because they are doing well. The question that the market is now asking, is it doing well enough to justify the price that has already been paid? Those are two very different questions, two very different outcomes. And again, it reminds me so much of Moderna. I'm not going to say any more about it, but it just reminds me so much of during COVID. You had that company make so much money, and things changed.
And even Samsung in their report are saying that they also expect memory price hikes to taper. So again, they're looking at this as sort of a short-term kind of thing. Whether it will be or not, that's yet to be determined. But it is what it is. We talked about it last week, and we talk about it a lot. When you have these trades, like you said, that have exponential growth in these sector trades that are highly concentrated because they are sectors and they do really well. Mm-hmm. It's not outside the realm of expectation. If you're shocked that it pulls back significantly sometimes, double digits sometimes, probably not the trade for you. And that goes back to the risk tolerance question too, is that taking your risk tolerance in a time where the market, particularly sectors of the market, are experiencing explosive growth, you're going to be the most aggressive investor that has ever lived. When you look at a semiconductor sector being 80 and 90%, why don't I have 80% or 90% growth? Yeah. I see this over here. These guys, my neighbor bought, NVIDIA. My neighbor bought, whatever they bought. And they're talking about their gains.
Can you give us some shares?
Why can't we get that? And so it's like, it works on both sides. You have to kind of moderate that.
And that's why for diversified investors, it's very important. And I love when I hear a story that something just worked out great. There was intuition, there was a little risk taking, and somebody was able to capitalize on these trends, or maybe even in some of our stock sleeves when those momentum signals really go in your favor and you're up 30 points, 40 points. I love that. But you got to measure with risk tolerance. And for the diversified investor, there's still a lot of gains to be had by staying diversified. We spoke this week about when we look at the portfolios, when you look at a client's portfolio or a prospect's portfolio, and we identify the components of that portfolio, right? So let's say if you have, $100,000, and if you're a 70-30 or an 80-20 investor, and we break those components out, our diversified equity position, which may be, say, 60 or 70% of the portfolio, is still, it's rocking great, right? You're going to even have periods of outperformance from the index with that position. But then you may have other components of the portfolio, such as your alternatives or your fixed income, that may be down. If your alternatives are composed of blockchain technologies, you'll have periods where those are down, but your equity position's doing well, and it may be even outperforming all these different indexes. So what happens though when indexes go flat or they go down? You want your bonds to come up, you want your alternatives to come up so that you can keep that average rate of return where you need it based on your risk tolerance to get the income in retirement you want, to live the quality of life you want. So there will be periods where you'll have FOMO, you'll have fear of missing out, and you'll have one sector or one part of your portfolio. You'll have one part where gold is ripping and your equities aren't, right? And you would say, well, why don't we put 100% in gold? Well, we don't want to do that, right? Because then that takes the risk tolerance to a level that we don't need to risk, because we don't need that. What we need is 10, 11, 12, 13% compounded annual rate of return over 20 years. That's what we need. So, just diversification is an important tool, but I don't take anything away from people that either by luck or by intuition took an overconcentrated bet and it worked. But you do have to be clear-eyed that there is a flip, there's 180, there's a flip side to that, which is why we think it's important to size those bets appropriately. We've spoken a lot about Bitcoin and Ethereum this year, and you want to size those allocations meaningfully enough to where as the regulatory tailwinds take effect, as adoption increases, you want to have enough allocation to where it makes a difference in your life, but you don't want to have so much allocation that it takes away from your ability to stay allocated, if that makes sense, right?
Yeah.
And for some people, that's different for everyone. It's really different. It's really different for everybody. You can have we've had 25-year-olds that are very conservative, and we've had 85-year-olds that want to let it ride. So it all depends on who you are, but you should be aiming for a diversified approach in some respect with how you deal with these things, especially AI spending and any type of commodity-driven play that you would do. What were we talking about? No, I'm just kidding. I know.
You?
Yeah, I do. It just, you want to have diversification, and you want to look at each part of your portfolio, not necessarily, yes, you want to take your account as a whole and measure that over time. But you have to also, when you go into your account and you look at each different position and each different asset that you're owning, you'll start to see that in a diversified portfolio that there will be periods of time where your equity portion, that may only be 60%, is doing great, but your bonds aren't. And that's okay, because eventually when the equities aren't, your bonds will. Or when your equities and bonds aren't, your commodities may be, or your alternative approach may be doing well. And that helps build that good long-term compounding effect. But let's get to the planning room and talk about something that's been in the news a lot. On the 4th of July, we had the kind of official opening of what have been styled as the Trump accounts. Now, I don't know what the legislative name is.
530A.
530A.
Yeah, that's the section of the tax code.
So that'll be the nomenclature over time that will become to define that, just as 401ks are. But in the news, the terminology being used now is the Trump accounts, or to be known as the 530A accounts. So a lot of parents are trying to figure out, what is all of this and how do I take advantage? Should I take advantage of this?
Yeah, all great questions. Let's start from the beginning and kind of build up to the practical questions. There is some confusion about what these actually are. There's confusion about who they're for, partly because the program went through a few name changes and some of the details are genuinely a little bit complicated. So as you said, it's the Trump account. 530A is the section of the tax code you'll hear it referred to. It's being administered by the U.S. Treasury, and Robinhood is powering a lot of the consumer-facing technology. If you download the app, which I have here on my phone, you will be greeted by a screen that tells you that BNY Mellon and Robinhood are kind of partnering with the Treasury to make this happen.
And this is a closely held, what I would say, it's more of a restricted approach. You cannot open these at the bank. If you get somebody sending you an email, it's time to open your account, your Trump account. It's going to be a scam. Yep. We cannot open them. JP Morgan cannot open them. It is a restricted, at this point in time, it is a restricted Treasury approved only vendor.
Yes.
That can open those. So
when you
get emails and crap, ignore them.
Right. So if you have a mobile phone that you use a lot, you can download the Trump Accounts app on Google Play or the App Store or whatever. It will walk you through the process. What you have to do is file what's called a Form 4547 with the IRS for each child.
And is that done through the app?
You can do it through the app. Yep. Because I had done it before before they released the app, I had done it. And for some reason it didn't take or didn't go through or whatever. So I had to do it again through the app. And then it was almost an immediate process where they got it, they approved it, and then the accounts were opened. And I got an email saying, hey, they were ready to be invested into. So I have 3 children. I have one for all of my kids. Talk about kind of what my decision behind that was in a minute. But the core concept, any child under the age of 18 with a social security number can have these accounts open for them. That's the broad eligibility, but there are specific groups within that get a little something extra.
Yes. So children born between January 1st of 2025 and December 31 of 2028. So newborns and recent births are eligible for a $1,000 gift or refund of their parents' taxes, deposited into from the U.S. Treasury into that account. So that automatically gets invested in the S&P 500 index fund. I believe it's managed by State Street
Spider
or State Street Capital. So the newborns get $1,000.
Yep.
Highly encourage everyone to take advantage of that if you're eligible.
Yeah. If your child was born before 2025, they still can have a Trump account. My kids are all born before 2025. They just don't get that federal $1,000 seed money. Now, some private foundations are stepping in for some of the older kids. Susan and Michael Dell famously came in and gave, something in the order of
$6 billion.
Yeah. And there's a lot of other people doing it too. And so they will provide $250 contributions to children 10 and under, but they are in certain qualifying areas. And I think they're even certain number of the first X number of accounts that get opened will get the
25
deposit.
million accounts are eligible as long as the zip code they're in has a median income under 150,000. That's going to cover most of the country, with the exception of probably San Francisco, DC, and I can't think. I mean, maybe Buckhead, some of these obscure kind of suburb areas near capitals.
Yeah.
But I think that it's a lot. And also Micron is doing 250, but only in states that they operate in.
Okay.
Much smaller pool of people. So some of those are like Michigan, Wisconsin, North Carolina, California, and there's a handful of others.
So it is possible that your child could get some seed money. They're not going to get the $1,000 if they weren't born. If they were born before 2025.
Get to 500.
Yeah.
Most likely 250.
Yes.
So,
yeah.
But aside from that, I mean, it's free money. I encourage you to look into it. Encourage you to take advantage of it because it's free and it is. It's a powerful tool. If the kid gets the grand born tomorrow, right, and doesn't touch it for 50 years, it's something, right? It's not nothing. It's something. It gets more powerful if you add to it. So for families with older children, here's the thing. The absence of the $1,000 seed may matter a lot less than people think once you understand the rest of the account, because you have the ability to contribute up to $5,000 a year in a tax advantage investment account. That is a significant feature because I've seen a lot of videos of, very well-off entrepreneurs that'll talk about, my kids have a Roth IRA because I hired them. Well, a lot of people
get that question all the time.
Don't have the ability.
Yep.
If you're working in your job, in your profession, you don't have the ability to hire your kid to do anything. Right. Or you may not have, when you hire the kid, you still have to pay wages. There's cost to that that go into it. And there's accounting cost, and you can get in trouble with the IRS if you do not do it correctly. So if you don't have a team of lawyers or your own business that you can do that from, we don't do that, right? And we do have lawyers and CPAs.
Well, we'll talk about the company side of that in a minute, but if we talk about the contributions, it gets interesting there. So the annual contribution limit per child is $5,000. That's the total across all sources. That's your parents, your grandparents, your family members, anyone contributing on the child's behalf. And then the $1,000 seed does not count against that. So you could be in a situation where you have a newborn and you could put $6,000 in the first year.
Yeah.
Because
what has previously happened, for instance, if we go back to some of our long-term relationships with clients that say maybe 12, 13, 14 years ago started funding kids accounts, and now those accounts are say worth 25 or 30 grand. You cannot get that 25 or 30 grand into an IRA in one lump sum. So what's going to happen is taxes are going to start being owed on the growth of that money once that child turns 18 or 19, depending on the state. And then those can only be placed into the IRA up to the limits, assuming that they have a job where they can do that, right? If they're in college, now we have 4 more years where they can't put it into a Roth IRA or a traditional IRA. This kind of bypasses.
Well, 18 is the max age here. So once you get to college,
right? Doesn't it convert
it's a little foggy about what it does. I would expect them to come out and clarify that in future legislation about what it does. Part of the tax code that it is referred to is in the retirement account world. And so it does ultimately become a retirement account, which is why I'm super interested in it, because, you know, it's not a 529. We'll talk about that in a minute, but there's an angle that is extremely interesting for people. And here's where I think is another thing that's getting overlooked, especially for business owners or people who work for companies with young children. Your employer can contribute to your Trump account as an employee benefit. This is huge. This is such a low hanging fruit for employers out there. If you're a small employer and you can't do benefits, do this.
Absolutely.
This is crazy.
Yeah.
Do this.
Absolutely.
Because you can put $2,500 per employee per year. So you can't even max the accounts out for the kids. So if you got 3 kids, you got to spread that $2,500 over the 3 kids. But the employer contributions count toward the child's annual limit. They're not on top of it. But employer contributions are tax deductible for the business, and they are excluded from the employee's taxable income. This is a fantastic idea if you are an employer.
Yeah, and I hope to see more of it, especially what I would call the good corporate citizens. A lot of these companies that have been very progressive in increasing benefits and a work-life balance for their employees, because they're, you know, companies, you know, there's a lot of them that catch bad press for good reason, but there's some that really have kind of under the radar been the first to expand, let's say, family leave when someone has a kid, right?
Yep. And
just really go above and beyond and help that work-life balance to keep good talent and to just, you know, they're making so much money anyway, and to try to be a better, as they say, corporate citizen.
Yep.
So I'm sure they will do it, but the small employers don't need to overlook the importance of this. Exactly right. Because, you know, sometimes people will stay in a job that maybe doesn't pay them what they think they're worth, but because of the relationship with the business owner or the work-life balance, they will stay in it. And if you can just give them this little bit for their kid's future, especially somebody that has a young kid, and you do this over 20 or 30 years, you're gonna really help change the trajectory of that child's life. Because for all of the problems in society, you know, giving somebody a good financial starting point when they're older is one of the most important things that you can do. And yes, some people may spend it all, but you're going to give them the ability to start off at a much better place. And if you can do that as an employer, you're making a real difference. So we're very excited about that for our own kids, for the tax breaks.
Yeah. Well, it goes back to, we did a little class at the startup was it last year that we did that? It's been so long ago, I can't remember. But we talked about how smaller employees have the benefit of being able to use flexibility and creative thinking and think outside the box to have these really sort of low cost but high impact solutions.
Yes.
Because they may not be able to offer things like healthcare or, you know, these things that people really would like to have in a job. When you're a small employer, you just can't do it sometimes. You got to get to a certain size before you do it. So this is one of those low cost, high impact things that business owners should be looking at. You've already got several major companies that have announced programs. You've got Visa, Dell, Comcast, Micron. It's basically a 401k match for your child's investment account. And so if you're a business owner specifically, I cannot appeal to you any more than this, but this is worth a conversation with your accountant. Set up a conversation. If you own a business, you can participate in this program. You can contribute to your employees' children's accounts. You can receive the tax deduction. You can provide a benefit that's genuinely useful for your team and also could change lives generationally.
Yeah.
Because this is not much, but it can't be accessed, right?
Yeah.
It's like you can't get it. Now, when they're 18, they can do with it what they want to. The idea behind it should be that this is a retirement account. That's how I would frame it.
Yeah.
You know, 529 is education. That's strictly for educational expenses. I would frame this as a retirement account.
Yeah.
Johnny, Susie, this is your retirement account. We're going to contribute to it for you as often as we can and as much as we can. When you turn 18, when you get a job, when you can have earned income, we can convert this for you to whatever it has to be at that point. The guidelines are going to become more clear, whether it's going to be treated as a Roth or right now it looks like it's going to be created as a traditional because of all the different mechanisms of contribution that you can have. But even still, you know, they provide math on this.
And
the Treasury does.
Yeah, and once it's designed, and the reason they're just doing the index funds, it's designed to be set it and forget it. As you know, market weighted indexes can be wildly volatile. Use that to your advantage. Even if you can't do it $5,000 a year, do $1,000 a year, do whatever you can, and consistently do it. And then as your child becomes an adult, starts getting into college or the workforce, they'll reach out to people like us to figure out, okay, now we've got this to 20 or 25 grand. How do we get it to 250,000? And we will consult, or other people like us will consult through that.
Even better than that, because if you start with nothing and you put $5,000 a year into these accounts at just a 9% rate of return, over 18 years, you're at almost $230,000. I mean, okay, you're 18 years old, you got $220,000 in a retirement account. You continue adding to that.
Maybe you don't tell them. Here's the deal. Yeah. Maybe you don't tell them.
You have to tell them. It's going to become their account. But this is where
take some white out on that last zero and then move the.
This is where the conversation happens with your family. This is what we have for you. We've worked really hard to set you up this way because not everybody is going to get out of high school essentially with a 6-figure account. This is the thing that's enabled by this, and it gets lost in translation because of the name. I think they did a grave disservice by calling it Trump accounts. I know that's a Trump thing. He likes to put his name on everything. I think they did a grave disservice by that. It should be like the 530A, or it should be a different name. But the concept here is phenomenal. It should not be overlooked just because of the political nature of it.
Yeah, and over time it won't be. Over time it'll. I think because of the impact that you are articulating here, it will absolutely, I think, and hopefully it just won't be utilized by the Fortune 500 companies as an employee benefit, but everybody will take advantage of the structure that it is set up, and it will become ubiquitous. We don't know who did the 401k stuff. I know the Roth, actually. That is a name.
Yeah.
Is it not?
Yeah, that's his name. The congressman or whoever introduced that legislation.
Okay,
his last name was
But now
Roth.
it's ubiquitous with tax-free money in retirement. So,
they could even choose a different name. They could expand it in the future. They could call it the American Retirement Account or something.
Yeah.
It just is an account that can grow tax deferred.
And I'm sure that it will. But yeah, you're absolutely right. Look past the naming stuff, but it's people are hearing about it.
Yeah,
which is good. But 530A Trump accounts, definitely something to consider. And Garrett's 100% right, which is the way.
I don't know if you can tell that I'm excited about it.
Yeah, I think it's
a great tool.
It's a good thing, but you're articulating the importance of what it can mean to a young person and the foundation that it can give them, and at the same time, tuning out the noise from the political nature of it is very important. We have to look at what the rules are, what's the impact, what the regulation is. That good for me and mine, right? Is it an intelligent thing to do? And that's the way you have to look at all of these things. We've said this numerous times, and I know we have to wrap, but if you're retiring today, at say 62 years old or 60 years old or maybe 65, in all likelihood, you're going to live to your late 80s and early 90s. So you're going to go through so many different political environments and different Congresses and Senates and presidents, and different changes and rules are going to change. And you always have to be clear-eyed about, okay, how is this change going to benefit me? Or maybe it harms me and I have to do a strategy shift. I have to talk with my advisor and what long-term strategies do I need to be using, because I'm going to live through so many of these different changes, and you have to, in your mind, depoliticize it and just see what's good for my family and what's good for my clients.
Yeah.
Embrace what's good, ignore what's not, and you're going to be set.
And if you have, obviously not newborns, but if you have older kids, start involving them in the conversations about finances, not obviously your family finances, but we have clients that will bring their kids to meetings. We have clients that introduce their kids at a young age to the concept of saving and to the concept of investing, and it becomes very important to them.
Yes, but what do you do? What do you do when they get the Apple Cash and you pay them for chores or grades, but then they discover that, because of my Apple Wallet, I can now get Cokes delivered via Walmart delivery at midnight.
Well,
what do you do with that?
That's the concept of buckets. So you can use your DoorDash money, but you also save 10 or 15% of it or whatever. But
then it's like, Dad, I ordered some cereal that just got delivered. It's 11:30. And he's like, can you go down there and get it because it's You've been on my driveway. It's a very long driveway. Yes. It's through the woods. I was like, take a flashlight. No. I was like, are you scared? He's like, yes, actually I am.
Well, I can't help you with that. Maybe sound off in the comments if you can help Matt with his parenting problems. But just, it's a conversation worth involving people in, especially as they get older. 18 is probably too late to start talking to them about finances. So yeah, that's just something to think about.
And little things do go a long way. And even sharing with them your successes and failures with your savings goals and with your investing, so they can help learn from what you're doing. And maybe you should have started contributing more to your 401k, or maybe you made a really good investment decision and it's how you were able to remodel your house. And share with them those successes at an age appropriate level and help them have ownership, especially if you're doing these accounts. Let them have ownership in the fact that, if you or your employer over the next 5 years have put money into it and it's gone up 15 or 20%, show them.
Yeah.
And say, look, this is working and this is what investing is. And then once they're adults, you of course will send them to momentumwealth.us for all of their investing and financial planning needs. Well, I think that's a wrap.
That is a wrap. Let's wrap it up. That's been Good Returns. Thanks for spending time with us. Good conversation, useful information. Please like, share, subscribe if this has been helpful to you. We will, I think, take a week off next week. We won't be here next week.
I will be here.
I don't know about that. Yet to be determined.
You will be here. You will be here.
Yeah, I don't think we're going to, there won't be a show next week. We'll come back the following week after that. But anyway.
I think you said we could do it next week, but it's the week after that we can't do it. Ooh, we're going to leave people in suspense.
Yeah,
I think you're off on your week.
I got to look at my calendar. Anyway, if we see you then, we see you then. But that's been Good Returns. So we'll leave it to you. Have a great weekend, and we'll see everybody. Yeah, maybe next week.
We will. Hopefully.
Leave it up.
Fingers crossed. Everyone take care. It's been great. Enjoy your weekend.
Goodbye.